All right, if you're tackling the C11 exam, you know this topic is a big one, the risk management process. I get it. Sometimes it can feel a bit textbooky and abstract, but trust me, it's one of the most critical concepts you're going to need to nail. So, in the next few minutes, we're going to break it down, make it super practical, and hopefully make it all just click. Let's dive in. So, to make this real, let's ditch the textbook for a second and meet someone. This is Alex. After years of saving and planning, Alex is finally about to open a dream retail shop. I mean, the shelves are stocked, the paint is fresh, excitement is in the air. The grand opening is just around the corner. But along with that dream, there's always that little voice in the back of your head, right? What could possibly go wrong? A fire, a break-in, maybe a customer slips on a rainy day and decides to sue? The list of what-ifs can feel absolutely overwhelming. But here's the thing. For us as insurance pros, these aren't just worries. They are specific, identifiable risks. And the good news? They can be managed. So how do we tame all that chaos? Well, we use this, the 5-step risk management process. This is the exact roadmap that professionals use to systematically deal with risk. It's not guesswork, it's a strategy. And we're going to use this exact process to help Alex protect that brand new store. First things first. Step 1, finding your risks. This is the bedrock of the whole thing. I mean, it's simple, right? You can't protect yourself from a threat you don't even know exists. So before we do anything else, Alex has to do a deep dive and figure out everything that's actually on the line. Now, here's a key tip for your exam. Every single risk, no matter how big or small, can be broken down into these 3 pieces. This is how we turn a vague worry into a concrete problem we can solve. So you ask 3 questions. 1, what's the asset? What could I lose? 2, what's the peril? How could I lose it? And 3, what are the financial consequences? How much is this going to hurt my wallet? Let's plug Alex's store into this formula. The assets, that's the easy stuff. All the cool inventory, the cash register, even the shelves on the wall. The perils, that's the how. It could be theft, which we call a human peril, or a fire, a natural peril. And the financial consequences? That's the bottom line. It's the cost to replace all that stuff, plus any legal fees, and maybe worst of all, the income Alex loses while the store is shut down. Okay, so Alex now has a very clear and maybe slightly scary list of what could go wrong, so now what? Well, that brings us to steps 2 and 3. This is where we stop being problem finders and start being problem solvers. It's all about figuring out our options and picking the best game plan. Basically, all the options you can possibly think of will fall into one of 2 buckets. On one side, you've got loss control. Think of this as playing defense. It's all the proactive stuff you do to stop a loss from happening in the first place, or at least make it less bad. On the other side, you've got loss financing. This is reactive. This is your plan for how you're going to pay for the mess after something bad has already happened. And here's a great way to think about it. Loss control is installing a sprinkler system to stop a fire from getting out of hand. Loss financing is the insurance policy that cuts you a check to rebuild the store after the fire is out. A truly great risk management plan has to have both. You can't just have one. So let's zoom in on loss financing. The first option is retention, which is just a fancy way of saying self-insurance. It means Alex decides to handle some losses on their own. For a tiny loss, like a customer accidentally breaking a cheap vase, Alex could use current expensing. Just pay for it out of pocket. For something bigger, they might set aside money in a funded reserve. But as you can see, each approach has its own pros and cons you have to weigh. Now for the other major financing option, and this is our bread and butter, risk transfer, also known as insurance. The trade-off here is pretty straightforward. The huge advantage is certainty. Alex pays a predictable premium, and in exchange, the insurance company takes on a massive, unpredictable risk. But of course, there are downsides. The premiums might feel like more than the losses you ever have, and sometimes the perfect coverage just isn't available or has limits. So step 3 isn't about choosing just one of these. The real art is in creating a smart, blended strategy. Alex is probably going to use a mix of everything. Some loss control, like security cameras, a little bit of retention for those small, predictable bumps in the road, and then a solid insurance policy to transfer the risk of a truly catastrophic event, like a major fire that could wipe out the whole business. All right, we're on the home stretch. We've found the risks, we've picked our tools. Now for the final 2 steps, actually putting the plan into motion and then making sure it stays effective over the long haul. This is where the strategy on paper becomes a reality. Step 4, implementation, is really where the rubber meets the road.
It's one thing for Alex to decide, hey, I need a better sprinkler system. It's another thing to actually do it. They've got to find contractors, get building permits, figure out how to do the work without closing the store, and then train the staff on the new procedures. This is the nitty-gritty, hands-on work that makes the plan real.
And finally, step 5, monitor and modify. A risk management plan is not a set it and forget it kind of thing. It's a living, breathing document. You have to check your work. For a huge company, that might mean tracking their actual car accidents against what they expected. If the numbers are bad, maybe their driver's safety program needs an overhaul. For Alex's store, it could be as simple as tracking shoplifting incidents month over month to see if those new cameras are actually working.
Okay, we have made it through the entire 5-step process. So now it's time to put what you've learned to the test with a quick C11-style quiz. Let's see how much of that just stuck. You ready?
Question 1. A slip and fall lawsuit, a fire, and theft. What are these things? Are they assets, consequences, perils, or control techniques? Think back to our 3-part breakdown.
And the answer is C, perils. Remember, the peril is the cause of the loss. It's the how it could all go wrong. Next up, question 2. If Alex installs a fancy new sprinkler system, which big picture technique are they using? That one is B, loss control. You got it. It's a proactive step you take to prevent or reduce the damage from a loss.
Question 3. Let's say Alex decides to just pay for those small, annoying, predictable losses right out of the cash register. What is the technical term for that?
The correct answer there is D, current expensing. It's the simplest form of retention where you just treat small losses like any other daily business expense.
Okay, last one. What is the main reason we have step 5, the whole monitor and modify thing? What's the point of that continuous cycle? And the answer is C, to ensure the program remains effective over time. And honestly, that might be the most important lesson here. Risk management is never done. It's a cycle. Because as a business changes, as the world changes, so do the risks. A great plan is one that's built to adapt. If you can master this process, you really mastered a core skill of our entire profession. Thanks so much for watching.